Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, May 6th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. Simple Market Signals is a proprietary trend direction and risk management model. I do have several charts for you this week, so please stay with me for the entire video. A lot of great information to share with you. And first thing I want to address is the first time in over a year. Guys, this is the first time in over a year that we've closed this low, and we will talk more about that on the next chart as well. But I do want to talk about the volatility over the last 2 weeks. So this particular chart that we're going to start with is a 10-day, 10-minute candlestick chart of the S&P 500. So each candlestick on this chart does represent 10 minutes of trading, and as you can see here, just super volatile over the last couple of weeks, and from a high of 4308.45 over the last during the last 2 weeks to a low of 4062.51. So this is now 4062.51, the new low for the correction, as I've annotated right here. The previous low was set back on February 24th, but we did undercut it this week on Monday. So 4062.51 is now our new low for the downturn. We came pretty close here today on Friday at 4062.91, as you can see, but 4062.51 a new low here. So the distance between this 4308.45 high and the 4062.51 low, and again, I'm looking at the last 2 weeks here, but that's a 6% move, guys. This 4308.45 number is 6% higher than this move here, and as you can see, once we hit that low, we basically went right back almost exactly to that same level, just fell just slightly below that, and then pulled all the way down here. So guys, just super volatile trading over, I mean, even just this week, but when you add in last week, it has been extremely volatile over the last couple of weeks. Now, let's move on to a weekly candlestick chart of the S&P 500 that goes back to the beginning of 2021, gives us a little bit more time perspective. And for the week, we actually were not down that much, right? I mean, we traveled a long distance this week, but where we started and ended up only 21 basis points difference. So the S&P 500, if you just looked at this number, you think, oh, ho-hum, big deal. But as we can see here, right, there was a ton of volatility this week in the overall markets, and of course we're focusing on the S&P 500 here. So down 21 basis points, 0.21% for the week. We closed at 4123.34, and if we look here to the left, we can see that the last time that we closed anywhere in the 4120s, if you will, was the first week in April of 2021, where we closed at 4128.80. So at 4121.34, we closed just a little bit below where we closed during that first week in April. So again, basically we've got to go back to March, right? So this is the lowest weekly close on the S&P 500 since March of last year, and as we know, it's the second week in a row that we've closed below 4,200 on the S&P 500, which is a level that we've been talking about for, you can go back over my last, 6-7 videos or whatever, and you'll definitely see me talking about the 4,200 area as well as the 4,350 area. And, so now that we're down here, guys, it's, it's getting a little scary. And I would expect, though, and I alluded to this last week, we came pretty darn close, but I would expect some kind of a bounce here over the next week or two for the, if for no other reason, the fact that we're now down 5 weeks in a row on the S&P 500, which is a pretty rare occurrence. So it shouldn't surprise us if we have a little bit of a relief rally over the next week or two, maybe gets us back to close to that 4,200 or, basically slightly over the 4,200 level. It's completely possible. But, any counter trend move, right, does not change the fact that we're in a downtrend. Okay. So right now, where we closed this week, we're 14.43% off of the all-time intraday high. The all-time intraday high set back on January 4th of this year. So, guys, we're not in a bear market yet, at least not in the S&P 500. There are things like the triple Qs that are in a bear market, but we're focusing here today on the S&P 500. So we're technically not yet in a bear market. We're still in a correction, and we're 1.86% negative now on a rolling one-year return. So I looked that up just before making this video, but where we close today, again, if you go back over a year, we're negative 1.86% on a rolling one-year return, negative 1443 below our all-time intraday high. So now let's talk about the maximum drawdown that we've experienced so far in this downturn. 48.1862, of course, all-time intraday high set back on January 4th of this year, and we know that we hit our lows of the downturn so far this last Monday, the 2nd, at 40.6251. So the total distance that we've traveled so far from our peak to the trough, right, the lows, 15.69%. So we've traveled a long distance. We pulled up a little bit, right, but we're still down 14.43% at today's close. So we're still a little ways off of a bear market, but this has been vicious, guys. And remember, we possibly can get 1 or 2 weeks of upturn here. It wouldn't surprise me at all, but be super careful because it's doubtful that we've seen the bottom in this market. Maybe a short-term bottom, right, that might allow us to go up for a week or two, but it is doubtful that the lows of this entire downturn have been put in just yet. Are you a financial advisor or an individual investor who manages any of your own money, including in your retirement plan at work or an IRA? If you are, please pay close attention to the balance of this video because it could be worth a lot of money to you going forward. Let me ask you a question. Do you have a stock market risk management and trend direction system in place? Do you know the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the trend of the stock market? My system is Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecast, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including numerous bull and bear markets. And what I found is that certain conditions exist during various market phases, and then I created simple, easy to understand signals around these different phases of the markets. And the thing is, guys, that most people don't know about or have access to the data necessary to do the research that I had to do to create this model. Simple Market Signals is a proprietary stock market risk management and trend direction model. And Simple Market Signals is perfect for financial professionals and individual investors. There's two major components to the proprietary model. There's a risk level signal and there's the general trend indicator. Let's start off with the risk signals. The risk signals are simply green, yellow, and red. The green signal has the lowest equity risk associated with it. And what you're going to find is that most all upward progress in the stock market will be made in a green signal environment. Said another way, it is hard to make money in equities unless the signal is green. The yellow signal means there's moderate equity risk, and sideways to slightly up or down price action is very common during a yellow signal environment. The red signal has the highest equity risk, and the worst sell-offs, including bear markets, will happen when the signal is red. A quick review of the risk signals. The green signal is the best risk-reward ratio signal for equity investors. And what you're going to find is that most upward progress in the stock market will happen in a green signal environment, as we see here. The red signal is the worst risk-reward ratio signal for equity investors. And what you're going to find is that the worst downturns, including the downturn in Q4 of 18 and the bear market in Q1 of 2020, plus the bear market from 2000 through 03 and the bear market of 07 through 09, all of those are going to take place in a red signal environment. Now let's put it all together and see how simple market signals could have helped you during the fastest bear market in history, which of course happened during Q1 of 2020. On February 19th, we hit what was at that time the all-time high on the S&P 500. Again, that's February 19th, and then things started to unravel from there. But think about this. Just a few days after the all-time high at that time in the S&P 500, on Monday, February 24th, the risk signal went yellow, and then on Tuesday, the 25th of February, the general trend indicator went negative. And that general trend indicator had been positive since October of 19, okay? So right there, just a few days after the all-time high in the S&P 500, the risk signals started to tell you that something was changing, that there was increasing risk in the stock market. And by Thursday, February 27th, the risk signal was red. And then, of course, the market sold off hard from there. So think about this, guys. I mean, you talk about stress testing my model during the fastest bear market in history, that started just a few days after the all-time high at that time, the all-time high in the S&P 500. In 1 week, the risk signal went yellow, the trend indicator went negative, and then the risk signal went red, all in the same calendar week, actually within 4 days, right? Monday, Tuesday, and Thursday. So you talk about stress testing my model. Guys, I mean, this is the fastest bear market in history, and look at how simple market signals could have helped you during that time. I want to show you something. I want to show you what simple market signals could have done for you so far this year. So let's start on January 3rd. That is the all-time daily closing high on the S&P 500 so far, January 3rd of this year, 47.9656. The very next day on January 4th, we hit the all-time intraday high. I just abbreviated that, ATIDH, 48.1862 on the S&P 500. And just about a week and a half later, on January 14th, my model, my Simple Market Signals proprietary model, which took me over 20 years to develop for myself, guys, produced the first of several warnings that the market was changing, that things were getting dangerous. And that came out at 46.6285 on the S&P 500, just 3.23% below the all-time intraday high. With simple market signals, you will know what the risk level is and what the trend direction is in the overall U.S. stock market. And the proprietary model is based on S&P 500 data. The S&P 500 index really is the best proxy for the overall U.S. stock market, and it's the only index that has all of the data available that I need to run the model. And guys, it's not about beating the S&P 500. However, that is a possible outcome over time if the tools within the model are employed properly. It's about risk management and risk control. It's about controlling your risk exposure rather than letting the whims of the market dictate your future. The signals are delivered to subscribers in our weekly video newsletter. In the weekly video newsletter, you will get weekly updates on our proprietary market mode signal. That's our risk level signal. And of course, you'll also get the updated chart for that signal each week. You will also receive the proprietary market mode risk level signal on all 11 major sectors of the S&P 500. You will also receive a weekly update on our proprietary general trend indicator signal, and of course, the updated chart for that. You will also receive market analysis on over a dozen charts every week covering all major areas of the stock market, including several international charts. So I'm going to cover small, mid, large. We're going to cover both a growth and a value ETF. I mean, guys, this is going to help you understand what's going on across the board. Of course, several charts every week on the S&P 500. We'll cover the Dow. We'll cover the triple Qs. So we're going to cover pretty much everything in there, okay? And so this is going to give you a really solid base every week as to what's going on in the stock market over and above our proprietary information that we're sharing with you. And then depending on what's going on, there will be occasional bonus material, not necessarily every week, but occasional bonus material, and this will be anything additional. From week to week, these things will vary, but these will be important and timely things that I feel that you guys need to know at the time that the information is delivered. To be fair to myself, I should be charging $97 per month or more for this information. However, you're going to get everything for just $19.99 per month. That's less than 67 cents per day. And to become a member of the channel and get access to the Simple Market Signals information, you will need to go to the Rodney E. Constable Stock Market channel. So depending on how you found the video, you may or may not be there, but you need to make sure that you go to the Rodney E. Constable Stock Market channel, and then you're going to click on this join button. Now, if you're not signed into YouTube, you will need to sign into YouTube. So you'll need to sign in. And then once you're signed in, then you'll see this box pop up, right? Get access to exclusive perks when you become a member. So you click on the join button and you will see the information here, what you're going to get with your subscription, of course, your membership. And then you click on the join button and you want to add your credit card information. So as you can see here, you can pay with either a credit or debit card, enter your card number, of course, the month and year of expiration, security code, cardholder name, and your billing zip code. So I'm going to fill all of this information in, and I will be right back. So once you hit that buy button, which is in the lower right-hand corner of that box, that previous box, you will then get this pop-up. Welcome. It's great to have you as a member. So then you can click on the See Perks. So once you fill all that out and your membership is established, then you will have access to the membership area where you will be able to see the perks, right? And then you go over to the community tab, and this is where you will have access to the various videos, and you just click on those and it'll pull those up. So I'm going to back up here, and so this is where all the training videos will be, as well as the weekly updates to the Simple Market Signals that will be under the community tab. And that's all it takes to become a member. It's quite simple. And you will have easy, convenient access to this information. Everything is on YouTube in the members area of the channel, and everything is in video format. There's no emails to mess with and no websites to log into other than, of course, YouTube. So just to review the membership details, the video membership to Simple Market Signals through YouTube is $19.99 per month. That's less than 67 cents per day, and it's billed monthly on your credit card, or you can pay with PayPal. There are no contracts. You can cancel anytime, and if you do cancel, your membership will remain active for the balance of that current month, right, for that prepaid period, but you won't be billed for the next month. All memberships are controlled by YouTube, so if you ever have any question about anything, just Google it, and the answers should be out there. Some of my clients tell me they make tens of thousands of dollars per year from the information they learned from being a client of Simple Market Signals. It's not often you have the opportunity to invest a few $100s per year in yourself and potentially pull out thousands or tens of thousands of dollars per year from that tiny investment. This year, give yourself the gift of financial knowledge that can bring you big rewards over your lifetime. So join now to start benefiting immediately from this valuable and potentially life-changing information. Now let me share with you what subscribers are saying about Simple Market Signals. First, we are going to hear from KT from Michigan. I have been trading for many years. I did not realize that I have been trading in a completely blind fashion. SMS has given me the direction, literally, I've been desperately needing. This service allows you to clearly see what the market is doing. If you are remotely serious about trading or investing, you must try this service. Again, that's from KT from Michigan. KT, thank you. I appreciate that feedback. Next, we're going to hear from SC from Florida. And SC writes, I manage my own money and I am not a professional, which could lead to a disastrous outcome as it has for many. Simple market signals is the equivalent of having a personal money manager that keeps you invested when it counts and alerts you to the potential dangers ahead. Now, I want to point out here, guys, I used to be a money manager. I sold my practice in 2016. So these are the exact words that SC from Florida wrote to me. So I just printed it as is. But I want you to understand, I cannot give advice. So again, SC writes, Simple Market Signals helps you stay invested when it counts and alerts you to the potential dangers ahead. The service is extremely affordable and takes the uncertainty and fear out of being in control of your own investments. I have done very well using this system and consider myself lucky that Rodney's YouTube channel came into view one day. I highly recommend this to anyone who desires an easy system to produce positive returns in the markets. Again, that's from SC from Florida, sent from his iPad. And guys, I want to point out the reason I'm using just the first and last initials is for the security of my subscribers, okay? I have hedge fund managers, very well-off, multi-millionaire clients. I have, people that are high up in various areas of the government. I have people from all walks of life. So just out of respect and security for my clients, this is the way that I'm presenting the information, just with their first and last initials as well as their state. Next, we're going to hear from FS from Massachusetts. Rodney is spot on in his reading of the markets. I was looking for a heads up to help me choose which side to use for vertical spreads. Again, that's from FS from Mass, and thank you so much, FS. I appreciate that. Next, we're going to hear from JV from New York. Now, I posed a few questions to my subscribers a few weeks ago, and this is the feedback exactly that JV from New York gave me with respect to the questions. So I produced it just as he wrote it. So the first question, what do you like best about simple market signals? What JV said was, one of the things I like best about simple market signals is that I have an easy-to-use tool at my disposal. I use the green, yellow, and red signals along with the general trend to help me determine how much equity risk exposure I want my investments to have in the market at any one time. I will either increase or decrease my equity exposure based on those metrics. The next question, what is important about simple market signals to you? JV writes, I am a conservative investor. My main goal is to preserve as much capital as possible during market downturns, yellow and red signals, and to optimize my returns during green light conditions. The next question, how has simple market signals helped you? JV writes, SMS helps me to determine whether to stay the course, increase equity exposure, or take defensive positions. For example, I will add additional funds to my equity investments during green conditions and move money to cash during red conditions. And the last question, how have you benefited from simple market signals? JV writes, one of the benefits of SMS is that it has reduced the stress from always looking at and analyzing market conditions and worrying about it on a daily basis. And again, this is from JV from New York. JV, thank you so much for the feedback. I really appreciate that.